Okay, I'm going to do a quick video. I'm going to try to keep this to 5 minutes, 5 or 6 minutes, but just wanted to show you a few ways that you can hedge your long portfolio, or how you can pack on some ETFs that will help pad, losses during a downturn. If you start seeing volatility, or if you hear some headlines or see something, or you just want to hedge, you want to get some hedges into your portfolio. You can do it this way without having to short anything, without having to buy any options if you don't like to do that. But what you can do is you can buy some inverse ETFs as well as some volatility ETFs. Okay. First, let's just do an overall market review. You can see here the heat map. Everything's red. Microsoft, Apple, Visa, MasterCard, all these companies, right, are all just red. Google, Facebook, Disney, not just tech, but some of these others, right? Financials, healthcare. These have been doing okay, have been doing well. We've had a recent rotation out of tech, out of growth, and into value, and into some of the reopening stocks. Some of these other ones that had been lagging. With last week there was some talks about, okay, hey, the yield curve is getting steeper, right? We have interest rates starting to go up. They're at their highest level now, I think, in the last year at 1.5%. So there's these talks about inflation, and when inflation happens, growth stocks aren't as valuable as they were when inflation wasn't happening or when interest rates were lower, right? Because they're, everything's about future sales and future earnings growth. So when there's inflation, those numbers aren't as strong as they were when they were first projected, okay? And then you have these other companies, that are in materials and stuff like steel, copper, lumber. These companies can charge more when, inflation happens, right? So think about an oil company. They can raise the prices. They're going to, fuel companies are going to raise the price of gas when oil goes up, right? When inflation happens. Apple isn't raising the price of the phones. Maybe they do, but it's not something that they shoot for. So the combination of rotation out of growth, and then inflation talks and rising interest rates, overvaluation talks, in the tech sector and all of that, reopening, people are going to be moving out of tech and growth and into airlines and Boeing and some of these other companies. It's just kind of fueled the fire today. So you got Dow, NASDAQ, and the S&P all down pretty hard on high relative volume. Not too high, right? But for what we usually see, we're over 1.0, right? So S&P sold off 2.5%, NASDAQ the hardest, which makes sense. Big rotation out of tech. Tesla getting crushed today. Apple not doing good at all, right? So I'm going to go into some things that we can look at for when this happens, or just a way to hedge against the overall market and specific sectors. So we have here, right, you can see NASDAQ drops 3.5%, worst day since October. Okay. Salesforce earnings did well, so maybe that's the one that we're going to look at buying. So let's see here. And you can see, you can just read through some of these top headlines. Tech leads U.S. stock rout as bond yields soar, right? So that's what it's all about. People, when there was said to be money, trillions of dollars coming into the stock market because interest rates were extremely low. But now that we're seeing bond yields are getting higher, money's going to come out of the stock market and go into bonds and things that are just, safer, right? Strong manufacturing and signs of improvement in the U.S. labor market. So that's another thing, right? Like, okay, economy's getting better. Maybe inflation is okay. Maybe we can start to raise some rates. And when that happens, you're going to have money flowing out of tech and growth, okay? So let's take a look here at what we can do when things start to turn down. This is a big ad. Okay. So I created this screen that's going to show us the ETFs that are up more than 3% today on the average volume more than 500,000. And right now I have them sorted by volume, but I'm going to change that to percent change on the day, right? So UVXY, VXX, and VIXI, these are all volatility ETFs, right? So this is long volatility. right? So when there's a hard sell-off, volatility goes up, right? This is like, they call it the fear index. So people get scared and they get worried, right? When there's a sell-off in the market, especially something like today where the indices move 2% and, the NASDAQ 3%, volatility really starts to soar. So these are up. It's no surprise that these are up 23%, 15 and 15. SOXS, this is the 3x bear of the semiconductor sector, okay? So 3x meaning it aims to deliver 3 times the daily return in the opposite direction of the semiconductor sector. Now that's a mouthful. So this is SOXX is actually the inverse of SOXL, which is the bull 3x daily semiconductor ETF, okay? So when this is up, SOXL is down, right? So this is like a hedge. If I own SOXL, I should have bought some stock or shares in this. I really should have, but I didn't. Anyway, this is how you can hedge against your portfolio, right? So you can say if I own a bunch of shares and I want to protect against a downside move, you can hold some UVXY shares or UVXY call options. You can hold some SOXS if you're long semiconductors, right? Even if you're long or you have a big position in one of the big names like Nvidia or Micron or AMD, you can hedge your position in those by just being long on the inverse semiconductor, right? If that makes sense. LABD, this is the inverse 3x of the biotech sector, right? So this is the opposite of LABU. And then TZA, that's small caps 3x. This is another small cap leveraged ETF. Tech S, this is the opposite of TECL, which is a tech 3x, just a different product than this QQQ, right? So this is the ProShares ultra short QQQ, and this is the technology ETF 3x bear, right? So these other ones, I don't do too much in gold. I used to, but not too much anymore. Dust and JDST, these are gold, right? This is an inverse FANG. I've never seen this, but it traded 6 million shares today, so maybe I'll put that on my watch list. This is, an inverse on the Russell 2000 again, and then SPXS. This is a 3x inverse of the S&P 500. So, you can look through these. This is the inverse of the financial sector. You see this one's not down as bad as some of the others because money has been flowing into the finance sector because of rising interest rates, right? But when the market does turn down, everything gets hit. So this is one, maybe you would want to buy FAS right now because the rise in interest rates is going to be good for the financial sector. So this is when you can take advantage of a dip in something that's only down because of the move of the broader market. Okay, so that's it. I hope that's helpful. Just wanted to show some ETFs that you can put on to hedge your long position or in individual sectors.